Good afternoon, everybody. Welcome to our webinar live at 12:35 Mauritian time. I'm here with Greg Stockton today, who is our Managing Director of Carrick Property. I'm Paul Jeffries. I'm the Regional Manager of Carrick Wealth Mauritius. And we're here to talk to you today about diversifying your portfolio through UK buy-to-let property. I don't want to take up too much of your time because I absolutely hate long introductions. So I think it's really important to get right into it. But let me just give you a brief bit of background. For the point of this particular webinar, it's important to say that there are three key offices that are involved in the process. We have our HQ in Cape Town, Carrick Wealth Cape Town. We have our Mauritius office where I'm sat today, and our London office. Obviously all relevant to UK property. Greg is our head of the property division, and he spends a lot of time traveling around, meeting the construction companies, the developers, visiting sites, talking to clients, building a portfolio of opportunity for us. So he's here today to talk all about that, and I'm here to support him and offer some assistance wherever I may, although he's the expert, and I will lead the Q&A, and I think that will lead me nicely into, if you have any questions, then please drop them in the chat box, and we will answer them either as we go, which might be useful for Greg if he has any pauses, or at the end of the webinar. So I think without further ado, over to Greg.
Thanks, Paul. Cracking intro, and yeah, thanks for the invite to the webinar today. I think you said obviously you're here to support me, but I think in fact we're probably here to support each other, right? You know, we've both been in the financial services industry for an extremely long time, sometimes unbelievably long, if you think about it. And UK property or property in general actually has become a lot more topic of conversation, I would say, in our world, probably in the last sort of 5 to 8 years. So there's definitely a need for diversification across all clients' portfolios, especially with the world we're living in today. So yeah, as much as you're here to support me, obviously I'm here to support you as well. So look, as Paul said, I'm the Managing Director for Carrick International Property. I've spent the best part of 20 years being involved in investment management, financial planning, portfolio management, but now have a 100% focus and dedication to helping clients diversify their wealth by adding quality property investments, mainly through the UK, but not necessarily restricted to the UK as well. And the format of today really was, rather than me host just a webinar where I end up chatting for 45 minutes to everybody, obviously me and Paul, we had a conversation yesterday, and we talked about really the relevant questions that are on sort of front of mind from him. And also probably on many of the clients that you deal with, Paul, and probably prospective clients as well, and some people on the call. So my presentation today is really just built around that sort of Q&A that we had yesterday. So look, I think probably good format is if we sort of backtrack and you sort of ask the questions that are forefront of mind, and you know, I'll flick through the presentation and land on a part which sort of identifies the answers. And I think that will be a much nicer format. As you've just said, you know, if there's anybody on the call that has any questions that maybe you don't address, you know, pop them in the chat. Obviously, we'll try and get around to them as quickly as we can on this call. But if for some reason we don't get around to answering them, then obviously we can go back on an individual basis. We can jump on Zoom calls and yeah, answer them as thorough as needed. So look, I'll hand back to you really, and just sort of, you know, for you to ask the sort of initial questions, and we'll go from there.
Yeah, thanks, Greg. Well, as a partner with you today, you know, I'm excited because property is not only something that we deal with day to day, but I'm personally passionate about it. And interestingly, I'm also currently looking at our properties from a personal point of view. So some of these questions I'll probably ask you that are quite close to home to me. But the first question actually that I would like to ask is, you know, why do you think interest is out there currently, you know, about international property, and especially across Africa? Why are we getting so much interest from Africa, do you think?
Yeah, look, it's a really, really good question. I mean, as you know, previously I was based in the UAE in Dubai for sort of 3 years, and you know, we were obviously talking about property and selling units, but the amount of interest that came from Africa and South Africa was incredible. One of the reasons why I actually decided to relocate back to Cape Town and set up shop in Camps Bay to deal with the sort of African continent. And I think if you look at, you know, just Africa as a whole and what's going on right now, it's sort of kind of obvious in a way. So you've got more and more people, South Africa, Africa, looking to transfer money overseas. I think that's fairly apparent and probably well documented in most sort of financial newspapers across the continent. You know, the reason they're looking to do that is because there's obviously concern around, you know, the political stability of maybe the country that they're living in, maybe a concern around the currency that they hold. You know, you've only got to take a look at what happened in Zimbabwe a number of years back. You know, we had some very wealthy clients in, you know, dollar terms, but their money was sat in Zimbabwe, and you know, they wake up one morning and, you know, you can't get your money out of the country anymore. So, you know, I think for that reason, lots of people are transferring money overseas. I think the advancement of technology, you know, you look at sort of investment platforms such as eToro, Interactive Brokers, you know, just general financial advice has been based in Africa. Obviously, Carrick have a number of offices in, you know, Zimbabwe, Zambia, Mauritius. So it's already given Africans a lot more exposure to the stock market, which has been a fairly easy transaction for them. So again, they've already got that in their portfolio. So to diversify property is an obvious one. I think lots of Africans and South Africans do tend to have an affiliation with the UK somewhat. So they've either spent time there studying themselves or potentially living at some point. They might be sending their children to universities there. They might already have friends and family that have relocated over there. So there's a good natural affiliation to the UK. And I think, you know, just in general, you know, most people across the continent have a good affiliation with property. You know, lots of people in South Africa and some of the African countries, they hold a lot of domestic property. They love it. You know, they like the bricks and mortar feel. They like to know that they can get a tenant in there and get that rental income. So, you know, for all those reasons, you know, sort of Africa and sort of international property has sort of skyrocketed over yeah, sort of the last 5 to 8 years.
Yeah, that answers. Really appreciate that. No, it does. And it leads me to a conversation I had yesterday, actually, where I was talking to a lady with interest from Asia, and we were talking about the attraction of the UK, and she was saying, well, you know, a lot of noise is occurring around UK property and interest rates and inflation rates and all these things, but she said, you know, to her, the UK price-wise is coming more into line with all markets that she's been investing in over the last 10 years. So it is interesting to me that, you know, Africa, obviously, you know, I think if you've got money on deposit in Nigeria, for example, you're going to get 6 or 7% return, but you're holding Nigerian currency. So, you know, looking for those sorts of yields out elsewhere is really quite difficult, isn't it? And I think, you know, looking at UK property has still got that attraction.
Yeah, I mean, look, don't forget as well, like, African property is expensive. You know, if you take Lagos, for example, I think there was at one point per square foot, it was more expensive than Manhattan, which is nuts, right? So, you know, property in Africa is expensive as well. You know, and that does lead us on to, you know, sort of, you know, why the UK makes a good investment proposition for clients when it comes to property. You know, your client there you mentioned in Asia, I'm not sure what part of Asia, but I've lived in, you know, Hong Kong and Singapore myself, and you know, the real estate there is incredibly expensive. And it's not that diversified. It's either super expensive or expensive. There's nothing really lower. Whereas if you look at the UK, and we look at a sort of snapshot of the last 50 years, which I think, you know, from the world that you and I come from, you know, traditional investment and stock management, 50 years is a pretty good barometer of, you know, where things have been and where they can potentially go. You know, over the last 50 years, UK property has only been the worst performing asset class in the UK 6 times. So if you look at that sort of sweetie chart graph that you've probably got in front of you now, you'll see the grey boxes, the sort of housing markets and housing prices. So where it's been at the bottom in terms of asset class performance, you'll notice though it's only down ever so slightly. Whereas if you look at the sort of stocks and shares of the FTSE 100 market, which is that pink box, when that's at the bottom, it's a heavy hit for an investor. Sort of 27%, 52%. Those are heavy losses to burden. And don't get me wrong, stock markets are volatile, so they do tend to bounce back pretty hard as well. But yeah, 6 times out of 50 years, it's been bottom performing. Only twice in the last 25 years has it been bottom performing asset class. Obviously, there's a big conversation around the world right now, especially in the UK, about rising inflation rates. Everybody wants to beat inflation. Everyone doesn't want their money eroded by inflation. So keeping money in the bank traditionally is a terrible idea. 19 out of the last 25 years, okay, property has beat inflation. So again, that should give clients some good comfort factor as an investment. But the biggest stat for me out of this, if you were ever going to take away a stat from today's webinar, when it comes to investment returns, 43 years out of the last 50, and that 50 is gone. We've gone through a lot of, I don't want to swear, but turmoil, let's say, over the last 50 years. We've had some big events that have taken place that have rocked the stock market, rocked the financial markets. 43 years out of 50 years, they've had positive growth. Okay, so when you're making an investment and you're thinking long term, not short term, 43 years out of 50 positive growth, that for me it's that comfort factor. It gives you that certainty and that confidence that UK property should be in your portfolio.
That would lead me into another question actually quite nicely, because obviously returns are super important. But what do you think it is that investors are typically looking for in their property investments, and in particular in current times?
Yeah, look, aside from the sort of emotional part of that certainty and that comfort, really they're looking for 2 things, which is yield and capital growth, right? So yield obviously being your sort of monthly annual returns from your tenant rental income. And it's interesting when we speak to people from African continent, and again, this is one of the other reasons why we set up here. There's some degree of, I think, lack of education when it comes to UK markets and UK property. I'll probably guess that anytime you spoke to somebody about UK property, generally the first thought is London. That's where people have been, that's where they visited, that's where some of the friends live. But actually, when you look outside of London and you think, okay, well, where are the yield hotspots? Where can I get really good value for my money? You'll see on that graph there on the left-hand side, anything sort of, in central London, around London, you're looking at a very low yield, 3% maybe you might be lucky to get out. There is a bit of a rental crisis in London, so you'll have no problem renting your apartment. That's the good thing. For every one, they reckon at the moment, for every 1 property that's listed for rent in London at the moment, there's 7 people trying to rent it. Okay, so it's a massive housing shortage across the UK, and that's a very good demonstrator to sort of what's occurring there. But as you'll see on that chart, the further north you go through the UK, the better that rental yield gets. So you look at the northern powerhouses, which is where we have quite a large focus, that Birmingham, Manchester, Liverpool type area. You're still looking at 5-6% yield, which is pretty good. You go further up north into sort of Yorkshire, places like Bradford, where you get able to eke out a sort of 6 to 7% yield, because obviously your price points of property does come down as well. But interesting on the yield sort of curves and the rental pricing at the moment, you've only got to switch on Rightmove, Zoopla, Prime Location, any of these UK websites, and see what's happening with rental prices at the moment. It's nuts. So inflation's a problem because things are going up, but ultimately that's just leading to sort of landlords putting rentals up as well. Interest rates are going up, so they've got to put the rent up to make sure that the mortgage is getting its face washed with rental. So you're seeing this big rental spike. So again, for the investor that's buying UK property right now, you're going to have no issue renting those properties out as long as you bought good quality property. But your rental yields, as long as you're buying in the right areas, can be very, very attractive still. And then the second point is really obviously the capital growth. At the end of the day, if you're going to tie your money up for 5, 10, 15, 20 years, you want to make sure that you're getting good returns on it. And this is just really a good demonstrator. It takes a snapshot of the last 7 years. You'll see that top graph there. The blue line represents the FTSE 100, which obviously most people will be fairly familiar with, so the UK stock market. And the orange line represents house pricing growth. Okay, so you'll see pretty much from 2015 to 2022, they both land up in fairly similar territory. But I think you probably agree, Paul, that there's less volatility and probably less sleepless nights on the housing pricing line rather than the FTSE 100.
Agreed, yeah.
The bottom line, however, takes into account the capital growth plus rental yield. So those colours are now inverted. So the blue line representing house pricing growth plus accumulated rental returns, and the orange line represents the FTSE 100. So again, just a really good snapshot of how much of a good stabiliser UK property can be within a portfolio. On the right-hand side, just some predictions from Savills over the sort of next few years up to 2025. Again, just to echo what I said before, London bottom of that pile. Still growth, 5-year growth of 12%, but just a lot less growth. So as you can see, further up the country, you get to that Yorkshire and the Humberside, 28% potential growth over 5 years. West Midlands, 24%. So although growth is slowing down, which most of the papers have pretty clearly latched onto, nonetheless there is still growth happening in the UK. So yeah, for those are the two things that most investors are looking for.
Very good. So in terms of that massive divergence across country, what do we do as a business? How do we source our property? How do we go about finding the property that we want to promote, if you like, for a better phrase?
Yeah, I mean, we've taken, I guess, the approach that you guys take on the wealth management side. Carrick Wealth doesn't have Carrick Wealth products. It's not like the red one on the shelf or the blue one. You sit down with your clients, you find out what they want, and then you'll go and work with providers to bring in quality product which suits that client. I think that's a fair high-level summary of what the wealth managers do. Yeah.
Yep.
And we've taken a fairly similar approach. We'll sit down with a client, we'll find out what they want, and then obviously we'll go and source property through different providers. What we will look at though is we'll look at, okay, with those providers, what developers are they working with? Okay, so are they working with best of breed? Because again, when you're buying property in the UK, there's lots of off-plan property being built. You've got to make sure that the developer that's building those units, is fully funded. They're very well capitalized. They're not sat on, huge bank debts. They're not necessarily using client money to build each floor of the building, which I know happens a lot in some other markets. And you see these almost like grey tombstones just like lying in the middle of the roads, waiting for another developer to come and pick up that project. So we always want to make sure that we're using good quality developers. And ultimately, we go to providers that provide us with that research. So some of the companies that we work with, RPA Group, they support us with some off-plan developments in Birmingham at the moment and in Brighton. We've got Joseph Mews, who work with some of the top developers in the UK. They've supported us with some projects in Bracknell and Bradford, again, off-plan. We've got One Global Group, which we tend to use for more of a bespoke search. So if a client says to us, look, I like what you've presented, however, I'm looking for something in maybe central London, despite maybe our best advice, it might be, a home, or it might be something for their children. Again, we can use One Global for that sort of executive search. And Fortum, we utilize really for our completed developments. So if a client turns around and says, look, I'm a bit concerned about off-plan, or I want my children to move in there right away, or I just take more of an emotional comfort by having a tenant in there ready to go, and as soon as I park my money I can get a return, then we use Fortum for some more of the sort of completed developments that they bring us. So currently we have a project in Surrey, which most people are familiar with from those guys, but yeah, so we tend to go to the providers, we lean on their expertise, they go and work with the developers, and we will obviously channel clients dependent on what their sort of aspirations, goals and needs are.
Did you bring some specifics with you today, some specific examples of some, I guess, Joseph Mews or RPA or Fortum's availability?
No, we've got a couple. I think just probably one thing I'm going to just quickly touch on, Paul, if you don't mind, just before I get into that, because I think it'll lend itself quite well when I go through some of those projects. Is, you know, if we've got people on the call, and I've just mentioned it now about that sort of off-plan versus completed. You know, you will have people right now start thinking, okay, do I want the investment risk of an off-plan? Would I prefer something that's already done? And I think just here's a couple of sort of key points. Some of the benefits of off-plan, and obviously some of the benefits of the completed. So off-plan, obviously that can be a lot easier on cash flow for stage payments. So, you know, if you've got a client who's confident they can put, you know, maybe 20% down now, you know, and another 20% in a year's time or 18 months time, it's obviously a lot easier on the cash. Off-plan means you can access a lot of sort of new and up and coming areas. You know, you look at what's happened across the sort of New Elizabeth line and going out into sort of Greater London, great opportunity to buy some off-plan developments there. Generally a lower entry price because you're purchasing them before there's even a shovel in the ground. So you're often getting that sort of initial price point, which means potentially a big capital growth increase over that sort of 1 or 2 year build. Usually they are more in demand. So if you look at that rental market that we spoke about in the UK, you know, any new build that's just handed over, the rental demand on that tends to be greater than an older building. Number one, a tenant probably is less likely to get issues with the apartment if it's just handed over and it's brand new. People like to feel like they've just walked into a new place. Sometimes the facilities tend to be a lot better spec, you know, more upgraded, more modern, and certainly in the world that we live in right now, often more energy efficient. You know, you look at some of the old builds in the UK, very old sort of pumping systems, water systems, heating systems. You know, people are really, really energy conscious at the moment. So, you know, a new build tends to be a lot more energy efficient. Sometimes the disadvantages, though, obviously on an off-plan, is you can't necessarily secure a mortgage like right now. So if you're buying a property that doesn't complete for 2 years' time, you know, you can't really gauge what mortgage rates are going to be in 24 months. So that is possibly something to consider. However, you could potentially go through a mortgage approval process now. So we've done that quite a lot recently, where, you know, I've had some clients who, you know, they want to buy one of the projects, but they're a little bit nervous to think, okay, well, can I get a mortgage or not? So again, we've walked them through a sort of pre-approval process. They've managed to get approved, so just give them that comfort factor. And obviously, you've got no rental yield during that build as well. So you put your money in there, but it's going to sit there, you know, for 2 years. And obviously, you've got the capital appreciation, but no rental yield. And then on the completed side, obviously benefits, you can lock in a mortgage straight away. It's done, you know where you're at. You know, even if you're slightly higher interest, at least you know you can plan for it. So you can start generating that yield initially. Obviously, you've got no developer risk because the property's already handed over and it's tenanted. And I think, I don't know, sometimes it's just emotionally an easier purchase for people. You know, the thought of buying something that doesn't exist yet, some people can't really wrap their head around. You know, buying something that's there, they can see, they can touch, they can feel. You know, sometimes, even if maybe they've paid a little bit more for it, it's just sometimes an easier emotional purchase. And again, the disadvantage there, again, often you're buying at a higher price. If you're buying a property that's really old, and again, you go onto the right Mews, the Zooplas, you can buy 1-bedroom apartments in some areas, and they are a lot cheaper than sometimes a new build. But, you know, a lot of those warranties have expired. You don't know what kind of internal issues you're inheriting when you buy properties. You know, is there damp in the floors, the ceilings, the walls? You never really know until you've bought it and you get those tenants in there, because they'll tell you. They'll ring you at midnight with the problems, and then you find out. And as I said, they're often less energy efficient. So yeah, just really be careful, I guess, is the thing. Whether you're buying off plan, make sure it's a good quality developer. If you're buying completed, okay, make sure it's newly completed and those warranties still stack up. So yeah, sorry I went off on a little bit of a tangent to your question there, but I think it's just sort of important as we dive through some of the properties. So if I start with RPA, so we have a number of projects from them. New Hayes, which is a London project. We've actually just recently this week sold out the last unit in that, unfortunately. So we should be looking at getting a new project in or around New Hayes. Bookbinder Point, which is in Acton. So this is on that Elizabeth line. Takes about 15 minutes into central London, into Paddington. So fantastic commuter story, you know, for anybody that, you know, wants to be in central London without necessarily being in central London. We have Scholars Quarter and Digbeth 1 in Birmingham. You know, if you look at what's happening in Birmingham, Paul, and people often ask me, they go, you know, London, Manchester, Birmingham, where would you put the money? For me, even though RPA have a fantastic product and a project in Manchester called One Victoria, which is just launched, for me, Birmingham is without a doubt the best place to put your money in that sort of, you know, mid-tier Midlands area. You've got the HS2, which is the high-speed rail, opening up in 2029, 2030. I don't know if you've heard about that, and I think we've touched on it briefly. You know, for anybody that doesn't know, it's a high-speed rail which is going to go from London, Euston, right the way through the UK, and the first stop on that is Birmingham. You know, you'll be able to get from Birmingham to central London in 45 minutes, which is crazy. So it's going to make Birmingham, in some respects, like a commuter city, which at the moment take, you know, sort of an hour and a half plus. You know, if you think about what's going to happen to Birmingham house prices and rental prices as soon as that train opens up, it's just going to absolutely fly. And guys smarter than you and I have already recognised that, Paul. You know, you look at Goldman Sachs, HSBC, PwC, Deutsche Bank. You know, they've already moved, you know, part of their headquarters or parts of their businesses into Birmingham, because they see the potential growth of that that bustling city. So yeah, we've got a couple of projects in Birmingham. We'll probably add another one in January. And as we said, you know, we've taken on One Victoria in Manchester, best of breed developer. The reason we've taken Manchester, we just get a lot of inquiries about it. You know, it's a cracking economy, obviously represents great rental yield, really good tenant profile. So yeah, we've got One Victoria in Manchester from RPA. Joseph Mews, we have 2 projects with them at the moment. Firstly is the Grand Exchange, which, as you can see, is like something that looks like it's come out of the future, but it's based in Bracknell, and most people probably don't know where Bracknell is, but it's a, you know, area about an hour from London. It's about 5 kilometres from Ascot, relatively close to Windsor, but historically it's the actual town and the city itself has not done a lot. It's now more recently, though, been coined the sort of Silicon Valley of the UK. So you've got all of these big tech companies that have moved into Bracknell. You've got Microsoft, Oracle, 3M, Fujitsu. So, you know, any pretty much tech company you can think of has got a headquarter in Bracknell. Great thing about that is it attracted a lot of, you know, C-level executives, young kind of tech entrepreneurs. The bad thing about it is there was no real estate to support those kind of people, you know, quite old townhouses type thing, and people want modern facilities, especially if they work in that space. So Seven Capital, which is the developer on this project, they saw that vision. They put their flagship project there, which is called the Grand Exchange. It started selling just over 2 years ago and sold out. Okay, so you're probably thinking, well, why the hell are you talking to me about it? More recently, though, what's happened is Seven Capital have decided to go sort of all in on a mega project in central London. They're building about 450 homes in Kensington, I think it is, which is just, I mean, unbelievable project. Potentially we'll add that maybe in the new year. But what that's meant is they give us back a number of units to sell to our Carrick clients. This project hands over in April. The great thing about these handovers, though, is they've allowed us to sell those units to our clients at the launch price 2 years ago. So from an investor perspective, you're getting a stack of potential value, because it's almost like going back 2.5 years ago and investing then. So you've got potentially 2 years worth of upside. It hands over in April. It's a brilliant development. You've got co-working spaces in there, gyms, restaurants, rooftop gardens, spas. Everything's controlled on an app for all the tech geeks that want to live there as well. So yeah, awesome project. It's going to yield pretty well on the rental side, so 5-6%. Short-term lets they've allowed people to do as well. So for those people maybe traveling in from the US on business that can rent an apartment for, you know, sort of a month or two, you know, fantastic project for somebody looking at, you know, that sort of higher end property investments. And then on a lower end, which is a sort of, we'd class it as an entry level project, is a project in Bradford. I know you might say, well, why the hell Bradford? And I said, why the hell Bradford, when I first saw it, to be totally honest with you. But when you actually do the research and you look at the regional cities which are developing and what's going on in those cities, Bradford, just from an investment perspective, does stack up. You've got about £500 million worth of investment currently being poured into the city for regeneration and redevelopment. That's on retail, commercial, residential, roads, transportation. And that's really because they've won the sort of City of Culture Award in 2025, which is going to attract a lot of eyeballs. It's been coined as the best rental yield city in the UK for buy-to-let. So the project that we're working on there is called Printworks, which you may be familiar with if you've ever had a Valentine's card pull. I know you've probably had a few in your lifetime, by Hallmark. So it was their old printing factory. So it was a refurb of that, plus another 2 phases. Estimated rental yield on it 6.5% on a long term, and then about 12.25 to 12.5% on a short term. So price points 120,000 to 155,000 pound, makes it super affordable for a lot of people that just want to kind of dip the toe in the UK market. Completes Q3 next year. So again, cracking entry level project there. And then finally, just again, to sort of discuss those completed developments. So we took on through Fortum Bagshot Manor. Okay, this is in Surrey, beautiful area of the UK. And funnily enough, lots of South Africans tend to live there. I think they like the grassy, leafy suburb type vibe. So this handed over in February. So as I mentioned, if you're going to buy completed, buy something that's newly completed. So you've still got the warranties on it, it's not worn, etc., etc. So as I said, this handed over in February. The developers give a number of units back to us to sell to our clients. The property is 100% fully tenanted. So when you buy the unit, you actually buy the tenant to some degree as well. So if you're paying £200,000 for the property, there's a tenant in there, they might be paying £950 a month. You know exactly what rental yield you're getting. It's already been paid. And funnily enough, when I posted this on LinkedIn about 3 or 4 weeks ago, I had one of my friends reach out and said, "Do you know that I live there?" And I went, "No, I didn't actually." So I actually have a very good friend of mine who lives in this development as well. So it was a little bit more of a comfort factor for me as well. But yeah, those are probably the projects that I wanted to go through today. But again, just to reiterate that, when we are looking at these projects, we do a lot of DD, we do a lot of research into the developers, the funding level, the history, are they listed, what have they currently built within the area? So we make sure that when we're handing something over to a client, it's best of breed. It might not always be the cheapest, but I'm a firm believer that, cheap is good, but good isn't always cheap. If I go back to that Birmingham project, Scholars Quarter, are there cheaper products to buy in that area? Yeah, but I also know the developers that are on them, and they're no way as good as King's Present Homes that are building that project. So you do tend to get what you pay for when you're buying off-plan property.
That's fantastic, Greg. Really appreciate that. And it's interesting, I've always been a bit of a fan of London or around the Greater London area. But as I mentioned earlier, I am very much looking at property, and definitely Birmingham catches my eye as the real opportunity in the UK. But I'm quite a cautious investor, and of course I'm overseas, a long way away in Mauritius from the UK, and the bit that I would always be very keen to get right is, the support services that I get from the company that I work with, and I guess how I might go on beyond that, perhaps with how I might rent my properties and getting the yields that I'm obviously going to look for. So can you tell me a bit about the support and the services that we give our clients?
Yeah, I mean, look, I think kind of what you've just said almost echoes why more people don't buy property in the UK that actually want to. I spoke to a South African guy yesterday, and he said, "I've been thinking about buying UK property for such a long time, but I've never got around to it because there's all these hurdles in my way." And the first hurdle is always work out, well, where do I buy and what do I buy, right? So where's the education come from that? If I do find a property that I like, can I even get a mortgage? I'm a foreigner, I don't have a British bank account, I don't have a UK passport. Is it even possible for me to get a mortgage if I want one? And the answer to that is yes. The last couple of months we've transacted about 19 mortgages for people across South Africa and Africa. Some of those rates differ. So just to kind of answer your point on there, obviously interest rates have gone up. But again, you know, these mortgage brokers that we work with, Madewell Group are one of them. Fantastic lady called Sophia. She works in Dubai. She's plugged into lots of the lenders in the UK. So again, kind of similar to where you and I work, she'll listen to the buyer, what it is they want, and then she'll go to lenders and find them a mortgage. You know, if I look at last couple of weeks or 3 weeks, we've had a mortgage come through for somebody on Bagshot Manor at 61% loan to value with only a 3.25% interest rate fixed for 2 years. Like, I almost had to double take, then double check, but again there. We had one come through last night for a client. It was 75% loan to value, but the interest rate was just north of 7%, because they are a little bit older and they don't necessarily have the income. So look, it is entirely possible to get mortgages, but again, it is very much a case by case. But I think when you are working with someone like myself, my first port of call is to make sure that whatever you're buying and whatever mortgage rate you're potentially going to get, that you're at least cash flow neutral. So it's not costing you every month to run your property. You know, if we can achieve that, that's great. Then we've got the capital upside. But obviously, if we can achieve that cash flow positive position, then even better. So we'll help with mortgages. We'll obviously introduce those buyers to, you know, good quality solicitors and lawyers as well to make sure the exchange is done correctly, which is obviously a big part. It can be quite frustrating for clients as well. You know, you're going to get an email with 15 different things that you need to provide from an AML perspective, you know, bank account details, 3 months worth of pay slips, etc. So again, making sure you've got good quality, patient lawyers and solicitors is really important, and as part of that process, so we make sure we do that tie up very well. When it comes then to making sure your apartment's tenanted and rented, because I guess this is a big concern, you know, especially in Africa, whereby I'd say at least 80% of the people I sit down face to face in South Africa that have bought South African investment property always end up getting tenant issues. Tenants not paying on time, tenants not paying at all, tenants trashing their apartments, etc., etc. And often it's because they've tried to manage it themselves because they're here, right? So look, we'll always make sure we introduce you to a good quality lettings and management agency, which will ultimately do a good job of finding you the right tenant profile. If you take the Grand Exchange products I spoke to you about, the Bracknell one, the tech one, you know, 7 Living who manage that property there. You know, again, we can give that out to other agencies in the area as well. But the sort of process on that would be to have the show homes ready sort of a month before handover to you as a client. They'll then start taking prospective tenants to the show homes, and they'll start creating data on people that want to rent there. They'll then introduce those tenants to you in terms of here's the profile. So it's always a case really of you choosing a tenant as opposed to having to find one. But again, as part of the process, we can make sure that all of our clients have a good quality tenant in their property. And then from the ongoing perspective, making sure that that lettings and management company, you know, they collect the rents on time, they pay you. If a client's got a problem with something, they call the agency. They don't call you at midnight, you know, pestering you because they've got a leak. So again, we farm that out to a good lettings and management company. So one would say for an investor, it's very much armchair investment. You know, you're part of the process of, first of all, understanding what you want to buy, choosing that property, and then everything else is pretty much taken care for you. I think we might have lost Paul. There you go. All right, so Paul is currently frozen. I'm not sure if they've got technology issues in Mauritius or maybe Wi-Fi issues, but yeah, hopefully that's answered his question and he didn't get too bored and log off. I haven't had any questions come through on the chat box from anybody, but for those of you that are listening, just as a final wrap up then, so as we've just touched on, that's our process for managing clients as Carrick International Property. The first port of call from you guys is really to get in touch with myself or Paul or any one of the team and just really express your interest in UK property, having that initial conversation. Very much the first meeting is very informal. It's an open discussion about your budget, about your goals, your targets, your ambitions, what you actually need and want from a property, what you need and want from the consultant. You might need some additional services as well, like maybe some tax planning, whether we can refer you to the wealth side. We also have a partner in the UK called HW Fisher. They're a fantastic tax partner to make sure that all of those questions are answered as well. So yeah, first protocol is just to get in touch with myself or Paul, and he's back again. Hi, Paul. Are you with us, Paul? Okay, so to save Paul some time, yeah, first protocol, get in touch with myself, get in touch with Paul, request a one-to-one meeting with, as I say, either one of us. We'll quite happily do the initial introduction and the initial consultation with you. From there, we'll then work with our property partners to find you the best property with the best developer, giving you the best opportunity to diversify your portfolio. I'm not sure if Paul's connected on the audio yet, but if he hasn't, Paul, I just want to say thank you for inviting me today to today's webinar. Obviously, for all of you that have tuned in and listened, whether you're in Africa, South Africa, or any other part of the world, I do always appreciate anybody's time that's given to me. So thank you for taking the time to join us today. Hopefully, we've done a good job of answering your questions. Apologies for the technological issue towards the end of the webinar. I wish you all the best for the rest of this week, all the best for a fantastic weekend, and look forward to speaking to you very, very soon. From me, thank you and goodbye. Cheers.